And data on earnings so far shows healing is underway across sectors in the S&P 500. RBC Capital Markets analysis showing that as of Thursday, the pace of EPS and revenue beats for the S&P 500 companies surged past 70%. That trend extended into the small cap Russell 2000 as well. Joining us now to break down the latest earnings season and what we can look ahead to as well, Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, is joining us now. It's great to see you, Lori. I actually have been reading your notes avidly on this theme of resilience, right? Or at least not as badness in the earnings reports. As Josh was pointing out, though, of course, especially as we look to the retailers this week, we're going to be looking at outlooks. How have the outlooks felt to you, and what are the implications for stocks?
So, I appreciate you reading, Julie. Sell-side analysts always love here that we're being read. But the reality is that whether we're talking about recent trends, outlooks, even China commentary or pricing commentary or inflation commentary, everything seems pretty balanced between companies who are saying, they're like, if you take the recent trends or the outlooks, for example, that they're cautious or things have been starting to slip a little bit. And then on the other hand, you have a lot of companies expressing optimism. I wouldn't say they're jumping up and down excitedly, but having a more optimistic tone. And those who are saying, well, things have actually been holding up pretty well. I do notice when we look at the consumer companies, and they've been trickling in, we're obviously getting a big dose of those this week. You still see that same old story between goods and services. So the goods companies sound a little bit more pessimistic and the services companies sound a little bit more optimistic, are still talking about how consumers have plenty of money to spend, are determined to go out and travel and live their lives, sort of that kind of post-COVID, let's just get back to reality, kind of driving behavior. You're also seeing, the story of the lower end consumers are getting hit hard or hardish, while the higher end consumers are still out there determined to go out and spend. So we've been hearing about those for a lot the last, year or so. We're still continuing to hear those themes, but overall, this does not look like an economy to me that's teetering off the edge of a cliff. It does look to me like whatever we end up calling this, big recession, or recession with a big R, little r, growth scare, something kind of in between, whatever it is, it's getting started. And I think that is very, very good news for markets because we paid for a recession back in October. Investors are really eager to start looking ahead to a recovery. I think markets are clinging to the idea that 2024 will be more of a recovery year. And so far, the commentary that we're seeing from companies, consumer companies included, is permitting that hope to stay alive.
What type of resiliency would you need to see over the summer from both end consumer or even business consumer purchasing activity in order to signal that that recovery is fully intact and healthy at the other side of it?
So that's a great question. I don't know that there's any one quantifiable stat that we're looking for. I think that there are a couple ways this could go. One, things could just end up being better than anticipated over the next few quarters, and then we kind of muddle along next year and have a more, sort of sluggish type recovery. I think markets would be fine with that. I mean, I do think that's one of the things, that idea that it will be a sluggish recovery going forward because we have sort of a shallower downturn, so to speak. That's been really powering a lot of the moving growth stocks. Growth stocks tend to perform better when sluggish economic conditions are anticipated. On the other hand, we've also been having a lot of conversations with investors about, what is some of the fallout from this regional banking crisis? What does that mean? If there's a negative impact on corporate confidence, so we see layoffs pick up, if we see lending standards, really continue to tighten a bit more aggressively than what people had already baked in, pain could get accelerated into 2023. I don't know that that's necessarily bad for the stock market. I think that the sooner we can kind of get through whatever this is, this economic challenge period, just get it started, get it over with, and allow whatever recovery is coming to really take hold in 2024. I think that's good news for stock markets as well. So I could really see it go either way, and I think they're both good outcomes for the market.
As we sort of muddle through this year and cross our fingers for next year, are there particular places, though, that you think are still going to be able to perform this year, outperform this year within the market? As you mentioned, growth, large cap tech has been strong. We're going to talk more about that with our next guest in just a few. But is that a place that still continues to perform?
So I think it depends on what you mean by tech. And I like the classic GICS tech sector, which is going to be everything from software, semis, hardware, comm equipment, kind of old economy tech. I think that in that part of the market, software, for example, there's still a lot of stuff that we can point to as having secular growth tailwinds. I also think things like semis might be a slightly different story. You saw really a bottoming out in the rate of upward revisions and earnings sentiment last year. That's still in recovery mode. It's kind of hovering around neutral revisions right now. I think there's some continuation of that recovery to come. So I feel very comfortable with that part of tech from both kind of a cyclical perspective and a secular perspective. Where I get a little more concerned, Julie, is when we talk about internet companies, and those are not sitting in the tech sector. Those are sitting more in communication services and consumer discretionary. I have had some clients, sort of raise the red flag to me saying, look, I don't think these companies are really growing as fast as they were in the past. Do they really still fit in this secular growth bucket? I think you can take either side of that issue. Obviously, some of the bigger cap companies have moats, is something our analyst talks quite a bit about. And I think he has a fair point. But I will say investors are questioning some of those secular growth tailwinds at a minimum in areas like internet. So I'm not sure if that's necessarily where I want to be in terms of playing a longer term sluggish economic backdrop. I would stick more with software companies where I'm a little bit more secure that those growth dynamics are still really there.
Lori, while we have you, debt ceiling talks are expected to resume Tuesday as the defaults deadline of June 1st looms ever closer here, particularly from a strategist perspective or even just evaluating how the markets could continue to move with that X date in mind. What most notably would you be tracking for in shifts? And if we get past that date, where might investors want to kind of steer clear of?
So it's a great question. This has obviously been the biggest issue, in my meetings the last couple of weeks. I would say non-U investors a lot more worried about it. Hedge funds a lot more worried than say domestic long-only focused investors. I do think that there's the potential for big swings in the market around this issue. If you go back and look at every debt ceiling drama since 2011, you've gotten at least a 5 to 6% hit to markets before Congress has gotten around to acting. In major drama years like 2018, 15, 16, 2011, where there was a lot of other stuff worrying investors, those hits have been more like 10 to 19%. In my mind, we're looking at something potentially like a 5 to 10% hit if Congress really doesn't pull things together soon. Now, that being said, one of the things we did over the weekend, or really late last week, we published it over the weekend, was we did look at sector performance and past debt ceiling drawdowns. And we looked at every single one since 2011, not just the big ones. And we were actually surprised to find that the value part of the market gets hit a bit harder. So sectors like financials, industrials, energy, tech gets hit not as hard as some of those other areas. So we do think this debt ceiling drama has really been weighing on the value part of the market and buoying the growth part of the market, which strangely has added to the resilience of the S&P. So I would just say this is a very, very complicated issue, but I do think it helps explain some of the woes we've seen in the value part of the market recently.
Interesting. That is interesting, the sector part of it. How long, when is all of this going to happen, I guess? Because we keep talking about the debt ceiling. It doesn't look like they're making any progress. The market has not reacted. Is it a whites of the eyes situation before we start to see stocks really selling off in more dramatic fashion to this?
I think it is, Julie. And if you talk to like the non-U.S. investors, and I've been talking to a fair amount of those over the last month, I mean, they're much more worried than the domestic or North American-based investors who are like, look, they always get something done. And my response to the domestic investors is, yeah, sure, but they don't get it done until the stock market throws a temper tantrum. And if you look at the end of 2021, when Congress was controlled by Democrats, the White House was controlled by Democrats, and for some inexplicable reason, they still had a really hard time coming to an agreement. You saw actually markets slide about 5-ish% in real time in late September, early October, before Congress passed a short-term deal that got them through to December and allowed them to negotiate that longer-term deal that's expiring now. So even in a more recent example, where there wasn't a lot of other drama going on in markets, I mean, this still did, have a pretty big hit. I've also reminded investors that we went back again and we looked at every single one of these debt ceiling dramas since 2011. And it was not uncommon to see the stock market ignore the first or even second round of warnings. When you get closer to the X date and things do get a little bit more dire, that's when markets still tend to really, they really do tend to act up. So you do need to get closer to that damage point. And I think there was a little bit of skepticism maybe on Yellen's June 1st date. A lot of investors I've been talking to who are worried about this issue had thought July would have the X date. So I think just the fact there's some uncertainty around there, that's maybe one of the reasons why we haven't sold off too hard yet.
All right, thanks for really breaking this down for us, Lori, and hopefully we do not get to a July type of scenario here. I got too many weddings to be at that point in time. We can't have this hanging over our heads anymore. Lori Calvasina, RBC Capital Markets, head of U.S. Equity Strategy. Great to start the week off with you, Lori. Appreciate it.
Thanks for having me.
You got it.